you're looking to buy a house. You know you're going to need financing. This is going to give you a great place to start because I'm going to talk to you about how to shop for your rate, how to pick your rate, and how to shop for your lender. These three things are not the same, even though they're very intertwined, but it's important to understand that they're all different. What we're going to start with is the least most important thing, but it's the thing that everybody wants to know about, so I'm going to get it out of the way, and that's how to shop for your rate. And the first step with shopping for your rate is to understand that you have to do all your shopping on the same day. Rates change on a daily basis. So if you're checking with a lender on a Friday and you check with another lender on a Monday, they're not operating on the same playing fields because rates have changed from Friday to Monday. So you need to ask everyone that you plan to shop all on the same day about their pricing. Number two is that you need to paint a scenario first so that when you call, you're giving them all the same scenario. So the example we're going to cover is somebody doing a $500,000 loan with 5% down, and their credit score is estimated to be 760. If your credit score is 740 and above, you're going to get the same pricing regardless. 740 is the same as an 800 in the secondary finance world. So, but that's the most important thing. Shop them all on the same day. Pick your scenario. We're going to go over $500,000, 5% down, 760 credit score. I'm going to show you what the numbers look like from the mortgage lender's end on our side. I'm going to share my screen with you. So this is what comes up when I put those metrics into our system here. You end up with a variety of interest rate options. And what you got to realize is that you got to pick one of these. Each one of these interest rate options comes at a cost. So for instance, this 2.75% interest rate comes at a cost of $12,854. This 3.5% interest rate gives you back $5,216. It doesn't matter which one of these you pick. Just pick one because that's what you're going to use to compare each lender's pricing. So let's say that we pick this 3.125% interest rate. At 3.125%, the cost of that rate is $309. That means that if you were to call me and say, hey, Adam, I'd like to know what your cost is for a 3.125% interest rate on a $500,000 loan. I plan on putting 5% down and my credit score is about a 760. I would tell you that's going to cost you $309 in discount points. Discount points is the mortgage terminology for what your rate's going to cost you. If you were to call another lender and they said, well, my rate at a 3.125% interest rate is $506. Well, now you know that lender is about $200 more expensive than I am on the discount points. And you call a third lender and you say, hey, I'm buying a $500,000 home and putting 5% down and my credit score is estimated to be a 760. What's your cost at a 3.125% interest rate? I know that's a mouthful. You might want to write that down. They may say, well, mine is actually giving you back $100. Well, now you know that lender is about $400 cheaper to me on the discount points. But that's not the full story. You also want to know what the cost is for that lender. They may charge $1,000. They may charge $1,425 like we do. Some of them may have no cost at all. So you have to take whatever that cost is and add it to those discount points. So if we go back to this number here and the first lender said, my costs are $1,000. Well, his real cost for a 3.125 interest rate is $1,309 because you take the $309 in discount points, you add it to his $1,000 of lender fees, and he's really at $1,309. If you take the first lender who was $509, and he doesn't charge anything, well, his discount points seemed like he was the most expensive, but because he doesn't charge anything, he's actually a little bit cheaper than the guy that charged you $1,000, and because the guy that charged you $1,000 in fees is actually at $1,309, and the guy that didn't charge you any fees is at $509. It's only at $509, so he's about $500 cheaper. I'm hoping that makes sense. If it doesn't, give me a call. I'd be happy to walk through that with you. But that's how you shop for your interest rate. That's the basics of it. You paint your scenario. You call them all on the same day. You ask them how much is your discount points for a very specific rate. You pick that rate. You ask them all on that same rate, and that's how you figure out what the costs are. Now we're going to talk about the more important part, which is picking your rate, because just because a lender is the cheapest doesn't mean that you're making the best decision with picking that rate. So we're going to talk about that next. So let's look at these costs again. The lowest rate on here, the cost is $12,854. The highest cost is 3.75%, or the highest rate is 3.75%, which is the lowest cost. It actually gives you $10,692 back, which will probably be enough to cover all your closing costs. So you have a variety of options for how you want to do this. Now, if you are trying to figure out which one of these makes the most sense, the question you need to ask yourself is, how long am I going to be in that house? Because the amount of time that you spend in that house is going to determine how much money you want to spend towards getting your interest rate as low as possible. So let's start here with this 3.25% interest rate, because that's called the par rate. That's the rate where there's no discount points. It almost never makes sense to pick this rate, even though a lot of people do all the time. People call up their lender and they say, what's your interest rate? A lot of them will just give them this par rate, and this is what they go with. I'm going to explain to you why this would actually not be the best decision for you. So if you are picking the 3.25% interest rate and the principal and interest payment is $2,067, that means that that's going to be your monthly payment, $2,067, and that's your rate. But you had the option to go down to 3.125% at just $309. So if you were to take your monthly payment of $2,067, we're determining whether it makes sense to go down and to the 3.125% interest rate here. You take $2,067 and you compare that to the monthly payment of the 3.125% interest rate, which is a little bit lower of an interest rate of $2,035. You're saving $32 a month to go with that lower rate. Well, how much does it cost you to get that lower rate? In this case, it only costs you $309. The reason that's important is because if you take the cost of getting the lower rate of $309 and you divide that by the monthly savings, in this case, $32, you get 9.65, which means it'll take you staying in that home for 9.65 months, or a little less than a year, before you make back the money that you spent on the lower rate, and then end up with a monthly savings for every month after that. It's a no-brainer you should pay a little bit of discount points in order to get the lower rate there. But a lot of people won't do that. They'll just go with whatever the par rate is, and that doesn't make any sense at all. So the 3.125% interest rate in this case is a much better deal than going with the 3.25%, because after 9 months, you still have another 351 payments to make. And if you're saving $35 a month times 351 payments, you end up saving $12,285 over the life of the loan, which I think is $12,000 is a nice savings for paying $300 up front for. That's one small lesson on how to pick your interest rate. We can get more in depth with all of these here, but I'm just going to do one more example. Let's go with the lowest rate possible on here. The lowest rate on here is 2.75%. The cost of that 2.75% is $12,854. The monthly payment is $1,939. So if you're comparing that to the 3.125% interest rate, which we already determined was a smarter rate than the 3.25% interest rate, and you compare the $2,035 to the $1,939, 2,035 minus 1,939 is 2,035 minus 1,939 is $96 a month. So you're saving $96 a month, but you're paying $12,854 to get that $96 a month. So the way you determine how long it's going to take you to make back your money, you take the $12,854, you divide that by $96 a month, and you get 133 months, which is about 11 years. So you need to be in that house for 11 years in order to justify going with the lowest rate on the rate sheet at 2.75%. If you know you're only going to be in there for 8 years, then you spent way too much money trying to get the lowest rate to save on a monthly payment that you're never going to make back on from the time that you're in the house. So this is why it's important not to just click on the lowest rate on Zillow, because there are lenders out there that will let you pick the lowest rate possible and pay all those closing costs just to get that lowest rate, And it doesn't make any sense to do that. That's how you pick your rate. Lastly, wow, we're 10 minutes into this. This is a tutorial. It's worth it. The mortgage lender that you pick has to explain this type of stuff to you, because this is just one aspect of your mortgage. There's 100 different ways to write this mortgage. And if you just call, or not even call, you're just going online, you're just clicking, you never talk to anybody, you just click on some interest rate that's on Zillow, you fill out all of the stuff, and you hope that your one out of 100 ways that you structured it yourself is going to be the best way to do it, you're probably not going to be getting your best deal. It's best to go with somebody who knows this, who knows these products, who asks you questions about your situations, like, how long are you going to be staying in the house? What do you plan to do with the property in the long run? How much down payment funds do you have available to you? Are there any changes that you can make to your credit score? Is there anything that you want to restructure on your debt to make your debt to income ratio lower so your mortgage insurance isn't paid so much? These are all things that your mortgage lender should be talking to you about. If they're not talking to you about it, chances are you're going to end up paying for that. And that's going to be a lot more than finding somebody who's $200 cheaper on their interest rate. Also, lastly, the biggest mistake that people make when shopping for their mortgage lender is that they pick someone who does not write their loan before they go get a property under contract. Most people will fill out an application, get their credit pulled, and some loan officer somewhere will write them a pre-qualification letter and send them out shopping, and they never saw an underwriter. And that's a huge mistake, because now when you go find a property under contract, you're rushing to get all your documents in, you're rushing to go through the underwriting process, and if there's any problems that you come into along the way there, you're going to be rushing to try to fix those, and it makes for a very stressful experience, and you might not make your closing date. So the best thing to do is to get a lender who will write your loan first, get everything done. So the money's just sitting there, it's waiting, it's already approved. So once you pick your property that you want, all you need to do is get an appraisal, get your title work done, and we fund the loan, and it's done. And you get to put in a way stronger offer, because if you put an offer in and tell the seller, hey, I can close in 2 or 3 weeks versus I need 30 to 45 days, that makes you come in a lot stronger than the other people that are putting in offers that take longer to close. The seller probably want their money sooner. So anyway, if you have any questions, give me a call. I'd love to go through this stuff. I know this was a long video. If you stayed through to the end, I greatly appreciate it. I'm a mortgage nerd. Call me. I'd love to go through every aspect that any of your questions you want to talk about. So I will catch you later.